Right. So tonight we're doing chapter 14, which is long-term financial liabilities, but it's more focused on bonds payable and notes payable, because other types of long-term financial liabilities we're going to see in later chapters this semester. So a long-term debt is basically amounts that are not payable within a year or the operating cycle of the business, whichever is longer, but that you're going to have to pay for it. And you know this at year end. So in that you have bonds payable, long-term notes payable, you have mortgage payable, and they're all accounted for the same way. And then you have pension liabilities and lease liabilities that's for your final exam. So for bonds and notes payable, they're the most common type of long-term debt. The main purpose of bonds is that you have a need for capital, you have a need for cash, but the capital amount is too big for just one lender. So you're going to break that amount in small bonds amount. So most of the time it's $1,000, and people are going to pay them and then for them. And what they get in return is that you're going to pay them a coupon rate on those bonds at every interest period. And then the bond indenture, it's basically the contract and states the coupon rate, the sum of money that they're going to get back at the end of the bond's life. And yeah, basically every time that they're going to have an interest payment. Yeah. So when they're issued, you have to find the present value of the maturity value of the bonds. And then if you have issuance costs, they are directly, the bonds are directly adjusted for the amount of the cost. There's two ways to account for bonds and notes payable. There's an effective interest method and the straight line method. And IFRS only uses effective interest method, and ASPE can use either of the two. I'd say that from my experience, I work for a company that uses ASPE, and we still use an effective interest method because it's the most common one. Bank uses that when they give you the amortization table. It's always with effective interest method, so it's just kind of easier. But like practically, straight line method is a lot simpler and more convenient, but it's not used as much from what I've seen personally. And your bonds can be sold at par. They can be sold at a discount or at premium. And that depends on the market rate at the issue date versus the coupon rate on the bond. So here I put some kind of little guide for you to know if it's issued at par, premium, or discount. So at par, your coupon rate is equal to your market rate, and there's no premium discount. So your issue price is equal to your maturity value. Issue at premium, your coupon rate is greater than your maturity, then your market rate, and then your issue price can be greater than your maturity value. And then issue at a discount, it's the reverse of the premium. And with these two, the premium and the discount, you're gonna amortize the difference between your issue price and maturity value at every interest period. So here's kind of like a summary for at par. So here you see that at the issue date, you're going to have in your books the issue price. And then at each payment date, what you're going to find is the cash amount that is paid to the bondholders, interest expense that you have to record in your book, and then the amortization amount that you're going to calculate to increase or decrease your book value. Since it's at par, you have no amortization amount. And then your calculation for your cash and interest expense is going to be equal. So to find out the cash, you do your maturity value times your coupon rate divided by the number of payments per year. And for your interest expense, it's your book value of the previous period. So in this little table here, it would be your issue date book value times your market rate divided by the number of payments per year. And then at each payment date, the transaction that you're going to record is your interest expense debited, and then you credit your cash amount. And also this is for the effective interest method. Like the next slides that we're going to see, it's all effective interest period method. For bonds issued at a premium, the same calculation is done for the cash and interest expense, but here you're going to see that your cash amount is going to be greater than your interest expense because your rates are not the same. And so you're going to have an amortization amount that you're going to come and reduce it from your book value of your bonds payable. And your journal entry is going to be your interest expense, bonds payable that you're going to come and reduce by your amortization amount, and then cash. And for discount, same calculation for these two, and then you're going to have an interest expense that's greater than cash. So you do your interest expense minus your cash, and you add that amount to your issue price. And so your transaction is going to be interest expense debited, and then bonds payable and cash on the credit side. For the straight line method, which is, I remind you, only for ASPE, you're going to have the same calculation for your cash amount that you pay for the bondholder. So you still use your coupon rate times the maturity value. And if you have a premium or a discount, so basically if you have a difference between your issue price and your maturity value, that difference, you're going to take it and you're going to divide it by the number of periods, so interest payment that you're going to do over the life of the bond. So let's say I issued a bond for 20 years, then I'm going to divide my premium by 20 years. And you're going to increase or decrease your bonds payable by that amount for each period. So you're not going to have a difference. It's always going to be the same amount. And for your transaction, your interest expense is always going to be a plug. So what you're going to do, you're going to have your bonds payable amount that's going to be your amortization amount that doesn't change. That's the little calculation I just explained. And then your cash amount, that's going to be your coupon rate times your maturity value, and then you plug your interest expense. And it's the same thing for your, when they're issued at a discount. For the recognition of debt, what you're going to see in the exam is normally when they pay in advance, the balance of their bonds before the maturity date. And usually what they're going to say is going to be like the company paid at 105 to end the debt, the bonds. So what happens is that you're going to have your reacquisition price, which is going to be 101, 103, 97, could be any of those. And you have your net carrying amount, which is the amount that you have in your books. And the difference between the two is going to be recorded as either a gain or loss from extinguishment. One thing that's important when you're doing that is that if at the time that you're of reacquisition, so at the time that you're paying the full balance, you have to calculate your interest expense up to that date. So if you have payment dates of March 1st and October 1st, and you do your reacquisition on May 1st, you have to calculate your interest expense from March 1st to May 1st in your books to get to your book net carrying amount on May 1st. So here's a little example. So on January 1st, 2020, General Bell Corp issued bonds with a par value of $800,000 at 97. During 20 years, 8 years after the issue date, the entire issue is called at 101 and cancel, assume straight line amortization method has been used. So we have a reacquisition price of 101, so 1.01 times your 800,000. And then our net carrying amount is basically your maturity value minus the unamortized portion of the bonds. So in this case, it's 800,000 times 0.03. That's to find our issue price, because it was issued at 97. So that's your like discount. Your issue price is 800,000 times 97, and your discount that you're amortizing each period is 3% of 800,000. And then since 8 years has passed already out of 20, what's left to be amortized is 12 years. So that's why we have the 12 on 20. So your net carrying amount in your books is 785,000. So your transaction is You get rid of your bonds payable in your books, you pay back your 101, and then the difference between the two is a loss on redemption of bonds. For troubled restructurings, it occurs when the company has financial difficulties or there's something in the way from them paying back the full amount of the bonds, and it's not in the contract that they can pay it back in advance. So it's like the lender is giving them a favor of being able to either pay it back in advance or change the terms of the debt. So that's what separates from an early repayment, like we just saw, or an exchange. An exchange could be like they exchange the debt for a new one. But for these two, it has to be mentioned in the contract. The two types of transactions, via the settlement of the debt at less than its carrying amount, or the continuation of the debt, but with a modification to its terms. So we're going to see the both of them. For the settlement of the debt, so it's basically an early repayment of the debt amount. So all the debt and any discount or premium is removed from the debtor's book. And usually there's going to be a gain for debtor because the creditor is going to give them more favorable terms. And then on the creditor side, they remove the loan receivable from their book, and they're usually going to record a loss. So it could be done by transfer a non-cash asset. So a building can exchange it for accounts receivable or other. They can issue shares. They can issue a new debt to another creditor. So they go to one bank, they issue a debt, and then they use the cash from that debt to repay their existing debt. If a non-cash asset is used, the debtor will recognize a gain or loss on disposal of the asset, like you've seen in ACCO 3 times. So you have to take into consideration if there's any accumulated depreciation, the fair market value, the book value, stuff like that. And then if shares are used, the market value is compared to the book value of the debt, and a gain or loss is recorded. If there's a modification of the debt's terms, so let's say that they reduce the maturity value, they reduce the stated interest rate, they extend the maturity date, stuff like that, what you're going to have to do is that you're going to have to find if these modifications are substantials. And there's two ways that modification could be considered as substantial is that if the present value of the new terms using the old interest rate is at least 10% different from the present value of the old debt, or if there's a change in creditor and the original debt is legally discharged, but you're not going to see point 2 in your exams. It's really focused on point 1. This is just for information, just focus on the first one. And then if one of these two are met and the transaction is considered a settlement, so a major, major reconstruction, I think, and otherwise it's treated as a modification. So if it's a settlement, you remove the old debt from your books and you replace it with the new debt using the new market rate to discount it. So you're going to have to be careful with your market rate because for the test, you use the old market rate. And then when you put in your books, you use the new market rate. And you're going to record a gain or loss for the difference between the two. And for the lender, they essentially do the same thing, but they use the present value. To find the present value of the new debt, they still use the old market rate. They don't really care if there's a difference. When it's a modification, so if it's less than 10% difference with your previous debt, the old debt is seen as to continue to exist, but with new terms. So my teacher, when he taught it to me, he only mentioned the ASPE way, but in the book, they also mentioned IFRS, so I put it in there. But I think if you only look at the ASPE way, it's okay. And from the exams that I saw, most of the time in your question like that, it's going to be like a settlement. I haven't really seen anything like that. Maybe in your assignment, you're going to see it pop out, but we'll see. So for ASPE, what you're going to do is you're going to redo your amortization schedule, where your issue price is the carrying value that you have currently in your books, and your maturity value is the new maturity value of the new terms of your debt. And then you're going to use in your payment the new maturity value times the new coupon rate, if there's any, and your payment terms, the longevity of your debt is the number of payments until the settlement of the new terms. So you're going to have to find a new market rate, and that's the market rate that you're going to use to record your interest expenses in your books. So you do like a little amortization table with the new market rate for the next interest payment periods. And in your book, you can see an example of it at example 1418. And then, like I said, for IFRS, haven't seen it anywhere but the book, so I'm not really sure if that's going to be in your exam, but just so you know, you remeasure the new term. The new terms will be remeasured to reflect the new terms discounted at the old interest rate. So you PV the new terms using the old market rate, and then you record a gain or loss for the difference between the book value of the old terms and the PV of the new terms. And then you calculate the amortization table as normal. And that's it for the theory. It's kind of light, and also like the type of exercise for this chapter are very similar. So I think that's a good thing for you guys, because it's going to be easier to practice. Just close this up. So is there any question on the theory, anything that's not clear before I jump into problems? All right, if there's anything, just let me know. So for question 1, VilPay Inc. owes a 10% 10-year, $600,000 notes payable to its banker, the Rock National Bank. The note had been issued at par and was coming due along with the interest for 2015 on January 1st, 2016. Due to a temporary cash problem, VilPay felt that it was not in a position to pay this debt commitment. Therefore, in early November 2015, it approached its banker to renegotiate the terms of its impending debt. After satisfying the banker of its sound long-term solvency position and its business viability, VilPay succeeded in obtaining several effective concessions. The bank agreed to forego the annual interest due on the note for 2015. Further, it agreed to extend the terms of the note by 4 years, commencing January 1st, 2016, and to reduce the maturity value of the note to $450,000, provided VilPay makes the cash payment of $90,000 on January 1st, 2016. And finally, the bank agreed to reduce the coupon rate to 8%. The deal was finalized by the end of the year and became effective as at January 1st, 2016. The market rate was 12% on that date, and both parties have adopted IFRS. So they're going to ask us to say if it's a modification or a settlement, so what we just saw, and what is the amount at which the debt is to be carried in the books of VilPay under the new terms, and the necessary journal entries on January 1st, 2016. Let me just open Excel. All right, so for 1, what we need to do here is to do the 10% test. So we have to find the present value of the old terms, find the present value of the new terms, compare the two and see if there's a 10% difference or greater. And if the difference is greater than 10%, then it's going to be seen as a settlement, and that's how we're going to account for it. So first, what I'm going to do, I'm going to find the present value of the old terms. So what they're saying to us here, we have the face value, well, the maturity value, and they're telling us that it was coming due on January 1st, 2016. So it's the present value right now in November. So you still have 1 interest period. So what you're gonna have your face value of existing notes, which is gonna be the 600,000. Yeah, I can zoom, yeah. Here, I guess. Is that fine? Oh, I think this is too much. Then I can zoom here. The Excel, okay. All right, so the face value is 600,000. And then we're gonna have the interest, the last period, which is your 600,000 times 10%, because our coupon rate is 10% and it was issued at par. So the interest amount, the interest rate is also 10%. And we're also going to reduce it by our cash payment of 90,000, because you can either put it here or in the present value of the new terms by reducing, well, by adding it. But I prefer to use it in the old terms. I find it more easier to visualize. So that's going to give us a present value of 570,000. Then to find the present value of the new terms, we have our future value of 450,000, which is mentioned here. That they say that they reduce it to 450,000. The new coupon rate is 8%. So we're going to use 8% of the 450,000 for payments amount. For the K, we use the old, we're doing the test now, so we're using the old market rate, and the old market rate was 10%. And then the number of periods, so they extended the term of the note by 4 years. So we're gonna have a 4-year period. So here we can find the PV now. Oops, that's fine. Rate is 10%. Number of periods is 4. Future value is 450,000. Oops, no, sorry. Payment is 36,000. Future value is 450,000. So in this period. And so that gives us a present value for the new terms of 421,000. So now we're going to have to find if it's a 10% difference. And to do that, you do the old term minus the new terms divided by the old terms. And that gives us a difference of 26%. So that's more than 10% difference. So it's a settlement. All right. So for 2, now we're going to have to find, okay, what amount do I record that new term in my book? So we're going to do the exact same calculation as what we did here. And the only change is for the K, because here in the test we use the old market rate. Now we're going to use a new market rate to record it in our books. Yeah, I can put it down. Let me just, oops. This doesn't work. There it is. Oh, okay. Hold on. So here I did 570K minus 421K divided by 570. All right, so here for the present value in our books, all we do is we change the market rate to 12%, which is the new market rate on that date. So that gives us a present value of 395,000. And then for our journal entry, we remove our old bonds payable. And that in our books, it was 600,000. We remove our interest payable, which in our books was our 60,000 here. we're going to have a gain or loss. So I'm going to leave it blank for now because I don't know yet if it's a gain or a loss. We're going to increase our bonds payable by the present value of the new terms that we found here. And we're going to have a credit to the cash account because of the 90,000 payment here that was made. So I think it's a gain, so 660,000 or 485. So it's a gain, and the amount is your debit minus your two credits here, and a gain on the restructuring of debt. Any questions for these transactions? So the thing that was a little bit funky in this question was the cash payment of 90,000. The rest was pretty much what you can expect in your problems. All right, so I'll jump to question 2. So for question 2, it's kind of like 3 little situations broken down in 3 questions. So first, you're going to have to find the selling price of the bonds. So on January 1st, 2009, Penguins Inc. issued a bond with a face value of 200,000 and a stated rate of 12% payable annually each December 31st. The bond matures in 20 years and is sold to yield 10%. And calculate the amount of cash received by Penguins Inc. So you calculate the present value of the situation here. So your future value is your 200,000. Your payment amount is 12%, which is the coupon rate, times your 200,000. Your market rate is 10%. And your number of periods is 20 years. So your present value is your rate. Yep. So your present value is 234,000. So just someone asked me to go back to the journal entry. So just let me know when that's good. For the next one, the next question, it's your entries related to bonds, so at issuance and also in later periods. On May 1st, 2008, Crosby Corporation issued bonds with a face value of 5 million and a coupon rate of 5% for 4.6 million in some crumbs. The effective rate on the bonds is 6%. The bonds pay interest each May 1st and November 1st and matures on November 1st, 2016. So they're asking us to prepare the journal entries on May 1st until December 31st, 2008, and that the company has a December 31st year-end, and they amortize any bond premium or discount on the interest payment dates at year-end. So I'm going to do first an amortization table for the first year of interest payments. I'm going to put down my dates, the cash amount, your interest expense, amortization, and then the value. So on issuance on May 1st, 2008, it said that the issue price was 4.6 million. That's what I'm going to put down. And then there is an interest period on November 1st, 2008. And your cash amount is going to be your maturity value of 5 million times your coupon rate of 5%, divided by 2, because there's 2 payments per year. It gives us a cash amount of 125,000. The interest expense is your book value of the previous period. So that in that case, it's May 1st, times the effective rate of 6% divided by 2. And then here I'm going to have a discount. So I'm going to do my interest expense minus my cash amount, and that gives me an amortization amount of 15,000. And I'm going to add the 15,000 to my book value. I wish sometimes that it was just like automatically like this, but can't have everything. All right. And then I'm going to do the May 1st, 2009 amounts. So here it's going to be the same thing. My interest expense is going to be, well, 6 divided by 2, so 3% times my previous book value on November 1st, 2008. And then oops, 3% here. And then I have an amortization amount of 15,580. And I'm going to add it to my carrying value on November 1st. So my first transaction is on May 1st, 2008, and that's your issuance date. So you got the cash, you received cash from your bond holders, and you also created your bonds payable liability for the issue price of 4.670 thousand and some dollars. Then you have your November 1st, 2008 transaction. And for this transaction, you're going to have your interest expense, which is the amount that we calculated here. You're going to have your bonds payable, which is your amortization amount here. And you're going to have a credit to your cash for the amount that we calculated. And then the last transaction for the 2008 year is on December 31st, 2008. So here, it's not an interest, you're not paying any money on that date, but you still incurred 2 months of interest expense. So you have to accrue your expenses in your financial year. So what we're going to do is we're going to take all the amounts that we calculated here for May 1st, 2009, and basically we're going to do times 2 months divided by 6 months, because the May 1st, 2009 amounts here are for the months of November 2008, December 2008, and then January to May 2009. So we just want to record the November and December amounts for year end. So the interest expense, we're going to take the amount that we found for May 1st, 2009, and then we're going to, well, if you prefer to see it that way, we're going to divide it by 6 months and then times 2 months. And that gives us an amount of 46,859. So what I did the 140,580 divided by 6 months times 2 months. And my bonds payable amount, we're going to do the same calculation, but the amortization amount that we found earlier. So we're going to take our 5,580 divided by 6 months times 2 months. And then our cash, same thing, or 125,000 divided by 6 months times 2 months. And that's all the journal entries for the year 2008. All right, so for C, bond repurchase, so what we're gonna have to do is basically get rid of our old debt I think it's just getting rid of our old debts because they're paying it back. I'm going to read first. So ABS Inc. repurchased some of its bond on the market on June 1st, 2009. Face value of the bonds repurchased are 2.3 million. The related unamortized discount recorded on March 1st, 2009. The last interest payment date is 137,277. Effective rate is 6%, coupon rate is 5%. They have interest payment dates of March 1st and September 1st. And on June 1st, 2009, the bonds were repurchased at 103, which included the interest accrued. So first, what we want to do, we want to find our carrying value of the bonds on March 1st, 2009. So we're going to be able to calculate after our interest expense from March 1st to June 1st. So we have our face value of 2.3 million. And we have our unamortized discount of $137,000 here. So since the discount, I'm going to remove it from the 2.3 million because your at a discount, your face value is lower than your your issue price is lower than your face value. So I'm going to do minus 137,277. And that gives me a carrying value on March 1st of 2.1 million approximately. All right, so then what I'm gonna find is the accrual of interest from March to June. So my, I'm just gonna do right away the transaction. So I have the interest expense, which is gonna be 6% divided by 2 because there's 2 payment periods, and then I'm gonna divide it by 2 again because from March to June is 3 months, and that's 3 months over 6 months. So technically March till September is 6 months, and then now I'm only doing 3 months out of the 6, so I'm gonna divide it by 2 again. And times my book value on March 1st, 2009. That gives me 32,450. And then that means I'm going to record my bonds payable, and that's going to be a plug. And an interest payable, which is the amount that we find with our coupon rate, but I put it as payable because it's not a payment date. They're not paying any interest to bondholders on June 1st. So the interest payable is going to be 5% divided by 2 for the 2 period payment dates, and divided by 2 again, just to find from March till June, times the face value of 2.3 million. And then you have a plug amount of the difference between the two. So of 3,691. So this, we're doing this because when you're paying back a debt, you have to record your interest expense up till the date of repayment. So that's what we're doing. We're recording our interest expense from March 1st till June 1st to have it in our book. And then what we're going to do next is going to record the repayment of the bond. Here, what I did the 6% market rate, so effective rate, divided by 2 for my 2 payment dates, and divided by 2 again because from March 1st till September 1st, it's 6 months, but I'm only trying to find from March 1st till June 1st, so that's 3 months. So, or another way you can see it, it's 6% divided by 2 times 3 divided by 6 months. That's easier to see. And then I did times the carrying value on March 1st, so times the 2,162,000. No problem. So yeah, for the repayment of the bond, you're going to get rid of your bonds payable, your interest payable, and you're going to record either a gain or loss, and you're going to also have a cash account for the amount paid on the repurchase. So my bonds payable book value is the carrying value on March 1st plus the amortized portion on June 1st. My interest payable that we reported on June 1st. Here, I'm going to have a loss or a gain, so I'm going to leave it blank for now. And the cash amount is 1.03 times my maturity value of 2.3 million. So I'm going to have a loss, I'm pretty sure. Yeah. So the amount of my debits here are smaller. So I'm going to have a loss on retirement of the difference between the two. I'm going to put the calculations on this side just in a moment. So here, how did I find it? I did 162.73 plus the 3,691. Here it's the amount from here. Here it's a plug. And here is 1.03 times 2.3 million. All right. Any questions for this question, for question 2?
Yeah, I have a question.
Yeah.
You subtracted the unamortized discount. Can you just explain why you subtract it?
I subtracted it because it was a discount. When it's a discount, it means that your issue price is lower than your face value. So that means that any discount that you have here, which is unamortized, so that means that it wasn't amortized yet. So it wasn't passed in the books yet.
Okay,
So
perfect.
Yeah, you got it?
Yeah, I got it. Okay.
Okay, perfect.
Yeah, thank you so much.
Any other questions? All right, if anything, let me know. For question 3, it's a common exam question that I've seen. It's basically where you have an amortization table and there's blanks and you have to find information that they request. So normally the market rate, your coupon rate, the maturity value, your face value, the number, stuff like that, that normally is given in practice problem, but now it's not given and you have to find them. So it's kind of working backwards to get your numbers. So the teacher has put on a full comedy bit in his assignment, so I'll read it out. You have been working as the controller of VZoom Corporation for the past 6 years. Last week, you had appointed a bright young student, David, from Concord University as a work-study intern for 1 year. Early this morning, the frazzled-looking intern approached you with a great bit of reluctance and apprehension. From the looks on his face, you can determine fear, both for his current placement and for his future career. He informs you that in his case to complete an assigned task, he just shredded the active folder instead of the archived one. Next, he shows you a very damaged piece of paper which David had rescued at a great risk to his hands and fingers. The document in its original state represented a bond amortization table, but now was totally shredded except for a few following lines of information. So here's the information that he rescued. And he sounded pretty desperate as he put his hope that if I'm unable to reproduce this table, I hope you're not going to can me tonight. He did not know the maturity value, stating that I'm pretty young and will become mature after a long time. About the coupon and market rates, he responded, I really do not clip any coupons. My wife does, and since she does all the shopping, I have no idea about all the market prices. We were told that the total cash interest over the life of the bonds would amount to $840,000. Further 13 interest installments were recorded up to and including the one on December 31st, 2020, and that 12 additional interest installments were due December 31st, 2020. Interest payments were scheduled every June 30th and December 31st. And so you sit down and show him how to reconstruct the table. In doing so, you need to answer the questions listed below. So they're asking us for the market rate, maturity value, coupon rate, the issue date, and the issue price. So I'm gonna just, am I gonna be able to copy this in Word? In Excel, do you think? Nope, okay, so I'm gonna do it. And so date, coupon, amount, interest expense. I'm gonna put annexation and then balance code. We have June 31st, 2020, December 31st, 2020, June 31st, 2021, December 31st, 2021, and June 30th, 2022. Coupon amount, 2142. All right, I think that's good. So the first thing they're asking us for is the market rates, which is the interest rate. And normally, how do you use the market rate? You use it to calculate your interest expense. And you use your market rate times the carrying value of the previous period to find your interest expense for the current period. So you can find it with the numbers here. So you have the interest expense for December 31st, 2020. And you also have the previous carrying book value. So to find this amount, normally you would have done the market rate times the balance owed, and you would have gotten this number. So we're gonna work it backwards. And what we're gonna do the 24,952 divided by the balance on June 30th, 2020. Yes, it's gonna be is it recorded? I think it's recorded, but yeah, it's gonna be uploaded too tonight. All right, so if we do the calculation, that gives us 4%. But the 4% is per period, right? It's not per year, because the periods, there's 2 interest period per year. So we have to do times 2 to find our interest rates. What did I do? Yeah, okay. And our interest rate for the year. So this is per period, and this is per year. Then for B, they asked us to find the maturity value of the bonds. And to find it, I'm just gonna complete my amortization schedule. There's probably some way to find it quicker, but since you don't have the issue, the coupon rates, you don't have the maturity value, it's a little bit easier to find it quickly. So I'll just complete my amortization schedule. And they said that from December 31st, 2020, there's 12 additional interest installments. So I'm gonna add 12. Well, I'm gonna add 12 minus 3. So I'm gonna add 9 more here. 1, 2, 3. So here, 1, 2. Or do after this one? Yes. All right, anyways, we'll see if we're supposed to get to a wrong amount. So my coupon amount is always the same, so I'm going to copy it down. My interest expense is going to be, well, my 4% that we just found times the previous book value. my amortization is going to be my coupon amount minus my interest expense. And I'm gonna reduce it from my book value. I'm reducing it because here I can see that it goes down, but also my coupon amount is greater than my interest expense. So that means there's a premium. So you can go down this way. Now what? Oh, I forgot to do something. Oh. All right. Okay, so there's some rounding stuff, but basically my maturity value is 480,000 at the end. Trying to see why it doesn't come equal. Maybe just some rounding here from the numbers, but we'll just put up 480,000. All right, so my maturity value is 480. So that's what I'm gonna put here. So how I found it, I just completed my amortization table. Then to find the coupon rate, what you're gonna do is work it backwards like we did for the interest percent for the interest rate. Wow. So normally how you find your coupon amount is you do your coupon rate times your maturity value. So now what we're going to do our coupon amount divided by our maturity value to find the percentage. So I'm going to do 33,600 divided by 480,000. That gives me a coupon rate of 7% per period. And so it's going to be 14% per year. Then they say to find the issuance date of the bonds. So we know that the numbers of period is 25, and how we know that is that they said here that there was 13 interest installments up to December 31st, 2020. That's 13 plus 12 additional, so plus 12. So technically, if I go here, I should add 11 lines. 1, 2, 3, 4, 5, 6, 7, 8. Right, December. Yeah. But that's the payments dates. So I'm gonna add one more date for the issue date. It could be either or. So this is if you're issuing on June 30th, but you're only paying on December 31st. And if you were gonna pay it directly on December 31st, and your issue date would be December 31st. So it's either June 30th or December 31st, 2014. Both are good. Oh, no, sorry. It's definitely June. Never mind about the December 31st. It's either June 30th, 2014 or July 1st, 2014, because sometimes they'll start it like a day after the last interest date of the year. So in this case, your interest dates are on June 30th and December 31st. So they're going to issue it on July 1st. So they get a full year of interest on June 30th of the next year. Hope that was clear. So it's either June 30th or July 1st, 2014. And then you could complete it, but we don't need to find the issue price of the bonds, because all we have to do is find the present value of the information that we already have. So my future value, I know that it's my maturity value. My payment amount, I know that is 33,600. My K per period is 4%. And every Penteca, what am I missing? My N is 25. So my present value is $704,000. So that's the issue price that they're going to have in the books on June 30th, 2014. So there's another, I did last semester, another similar question to that, but with different numbers. If you want to go check it out, it's great practice, and you're able to really understand the links between all the amounts in your amortization table. Yeah, Selena?
Just like on an exam, are we allowed to like have our Excels out and do that, like portion of it?
Is your exam still online?
I think so. I believe so.
Okay, yeah, you can use Excel then. Well, it depends also if it's, when I took it, the exam wasn't proctored, so I was able to use my Excel sheet and like any notes that I needed. So definitely if it's not proctored, then use it. And if it is proctored, which I would be surprised because it's Trevor, the one in charge of the class this semester, ask if you're able to. If not, I'll be surprised if you put a question like that because it's too long and too difficult to do just by hand, you know?
Yeah, exactly. Okay, thanks.
No problem. But you guys have Trevor, so he's more lenient, I found, in the exam than the course coordinator for the fall. All right, and for question 4, it's a settlement of the debt with an exchange of non-financial assets. So Big Buildings Inc. owes a $25 million to Arundel City Bank. Big Buildings cannot meet its obligations, has given to Arundel City Bank a building with a fair value of $20 million to fully settle this loan. Arundel City Bank has accepted this exchange. Big Buildings Inc. has a book value of $17 million instead of $7 million of accumulated depreciation for this building. So we're gonna have to record the journal entry for Arundel City Bank and for Big Buildings Inc. So for the bank, what's going on here is that they're gaining a building in exchange of getting rid of the notes receivable that they have. So they're gaining a building with a fair value of $20 million. They're going to have a gain or loss, and they're getting rid of the notes receivable, which was $25 million. They have a loss on settlement of $5 million. So the difference between the two. That's the easier because we don't have to think about the accumulated depreciation and stuff that you forgot from 310. And then for Big Buildings, they're gonna get rid of their notes payable, which was $25 million. They're gonna get rid of their accumulated depreciation that was in their books, which was $7 million. Then they're going to have a gain or loss and another gain or loss. So they're going to have a gain or loss for the loan settlement, and they also have a gain or loss for the disposal of the long-term asset. So I'm going to leave 2 lines blank here, and I'm going to credit the buildings account because they're getting rid of their buildings, which has a book value. Well, they're in their books, like the issue, I just have the issue price, but like the price they paid for the building was $17 million plus the $7 million, so $24 million. So first we're gonna have a gain on settlement of the debt, which is gonna be the same amount as for the bank. So it's gonna be the notes payable amount minus the fair value of the building. And they're also gonna have a gain on disposal of assets of, it's your fair market value, so the 20 million. Yeah, 20 million minus your book value of 17 million. So 20 minus 17 million. And then these two should equal, so that's 32 million and 32 million. And so that's the transaction for big buildings. And that's it. That's it for chapter 14. So as you saw, the main points, it's going to be major debt restructure, and then your question like these, where you're going to have to figure out with the amortization table, your coupon amount, interest expense, and balance owed. Yeah, any questions for chapter 13? I'm going to stop the recording if